So, Robin, how did John McQuown's interest in what we now call index investing begin?
Kind of in a circuitous fashion. So he studied mechanical engineering at Northwestern because he grew up as a farm boy, basically, and he loved the machines that they were starting to use. And he, by chance, took a finance class at Northwestern. It was his first exposure to finance. And frankly, it kind of left him a little bit cold. He felt it was a little bit it wasn't as rigorous as the engineering courses he was doing. But at least it piqued an interest. But it's only really after he graduated and then also, frankly, worked as an engineer on a Navy destroyer that he then decided to take an MBA and thought actually maybe working on Wall Street would be interesting. But at that time, there was nothing considered, even indices had maybe been around for a century, but they were not what we would consider indices. They were pretty pokey affairs. And, they'd measure the performance of active managers at the time. But he started feeding all the data into this IBM mainframe computer just for fun, essentially, to see if he could use computers to predict stock market movements. And he found out that, it was really, really difficult. It was impossible. Nothing really worked. So what he'd kind of discovered was what, Eugene Farmer around the same time, actually, at the University of Chicago, proved this was because, stocks move pretty randomly and they're very hard to predict, at least from past data. And I think that's kind of the kernel of what then became an interest in, maybe just a dude sitting around picking stocks, and it's normally a dude, isn't maybe the best way to invest. But he always had this thing that he wanted to beat the market. And the first version of what became the first index fund actually, it's something more like what we'd call a systematic hedge fund today. So essentially what they discovered, again, in the data when they started crunching it, was that low volatility stocks that didn't move around a lot, actually over time did better than the overall stock market. So they thought they'd basically buy all those stocks and just leverage it up. And that kind of sounds more hedge fundy. And for all sorts of regulatory reasons, it died, which is why they reverted to what was a fairly plain vanilla index fund. Because he wanted to beat the market. He wasn't, I'd say, at that time, an efficient market zealot. He believed that markets were pretty efficient and they were very hard to beat, but you could beat them possibly if you were just smarter and more sophisticated and more systematic, rather than, the proverbial throwing darts at a board of stocks.
But he clearly changed his view on that, didn't he, over time, Robin?
Yes. I mean, he always called himself a data dog at heart. Like, he was always guided by the data. I think everybody says they are. In reality, our priors are so incredibly strong. And Mac is, I've talked to lots of people that know him, and they describe him as this incredibly stubborn person. But a stubborn person who would quite easily change his mind if the data indicated otherwise. This is what Jeff Bezos calls strong opinions loosely held. And I think that's essential. And he was led by the data, and the data over time and increasingly, more and more, certainly as he grew older, it was clear that, the classic vanilla, cheap, market cap weighted index fund is kind of the optimal thing for most people on the planet.
Now, in your obituary in the FT, you described McQuown or the project that he worked on at Wells Fargo as the Manhattan Project of Finance. There was a real dream team working on it, wasn't there? I mean, who else was involved, and what were they looking to do essentially?
Well, I mean, the Manhattan Project metaphor is a bit of a sort of a literary sort of flair there, but I actually think it's not, incorrect, because I mean, you had 6 Nobel Prize winners that I know of that at some point worked or consulted for. So it was Myron Schultz. Fisher Black would have won the Nobel Prize had he not passed away before then. Merton Miller, Myron Miller, and who else were Bill Sharp, Harry Markowitz, and Gene Farmer. And, those were just sort of the people that are now famous. There were so many other people working in that orbit. Quite a lot of them, like the smartest grads from Gene Farmer's classes that he pushed out to the West Coast, to Wells Fargo, where Mac was working. What they kind of wrought was kind of like the atom bomb. What the atom bomb was for conventional weapons, the index fund kind of has been for the investment industry, even though it's taken, several decades to play out.
As you've explained in Trillions, there's still disagreement over who really set up the first true index fund, if you like. Should we be giving McQuown more of the credit?
I give him most of the credit, and I think broadly speaking, he probably does get the lion's share. And it's a shame that the people that are a very close second or third, nobody really remembers who came second after Usain Bolt at the the Olympics, right? Even though they are some of the fastest people on the planet. And I think it boils down to this disagreement boils down to essentially what you call an index fund. What Wells Fargo launched in July 1971 actually wasn't a fund. It was a separately managed account on behalf of Samsonite's pension plan. And it actually didn't really invest in an index per se. It invested in all the stocks of the New York Stock Exchange. So you can call that an index. And there are many reasons why I did it. And actually, it was a terrible idea because that means they had to rejig all the time. At the time, trading costs were huge. So actually, that was not a smart idea. As far as I'm concerned, though, that is the first passive fund set up deliberately to be passive, to track a market. And that makes it the granddaddy of the index fund world. The two other main ones that I think, deserve a lot of credit, even if they didn't get quite the first passive fund, was Rex Sinkfield at American National Bank of Chicago. He started in 73, an index fund that invested in the S&P 500. The reason why there is an asterisk next to it, it actually converted an existing fund that was doing badly into one that essentially just said, now we're going to track the S&P 500. So it got money first, but it converted. And Battery March, Dean LeBaron, a very eclectic, colorful character, he did it just almost to kind of stick two fingers up to the investment industry. He loved tweaking the nose of his own colleagues. And he started an S&P 500 index product in early 73, but actually didn't attract any money until, I think, January 74. So, they all have and should deserve a lot of credit. And I think maybe sometimes LeBaron and Sinkfield sometimes get forgotten. But I do think, Mac is the granddaddy. He's the man.
Finally, Mac McQuown wasn't just a quant investor. He was a real polymath with a very wide, eclectic range of interests, wasn't he?
It was huge. I mean, he grew up on a farm and he was always very interested in nature, climate change. He was an early philanthropist, gave lots of money to various climate change and environmental charities. He was always interested in fixing hard problems. A lot of that was in finance, obviously. So he actually had, it's kind of incredible. Some people just do one incredible thing in their life. He actually started several very successful companies after he left Wells Fargo. But he also bought basically large tracts of land in the Sonoma Valley where he started an organic vineyard. And first of all, that's pretty cool anyway, right? It's kind of a dream for a lot of us. But he actually turned it into a bit of a testbed for all sorts of renewable energy technologies. He built what was probably one of the first microgrids, like a self-contained energy grid that started getting all this energy from wind and solar. And I think for at least almost a decade now, it has been entirely self-sufficient with energy. It has a restaurant. It produces very good olive oil by all accounts. The wine is supposed to be fantastic. But he liked this technology thing. He loved tinkering and he loved always working. Even when I was interviewing for my book, it was incredible, like how often you still had to find the right time because he's always working. He was up in his 80s, almost certainly a billionaire, and he's always working and he loved it.
Thank you so much for your time.
Not at all. Thanks for having me on.